I know. Okay, folks. Quick reminder, if you needed one, that your quiz is day after tomorrow in the first 30 minutes of class in person. I want to be specific. For some reason, since COVID, people seem to assume that everything can be online. No, that's, it'll be in person. I did send you 3 rooms because if you look around you, and this is not even the full room, if everybody were in this room and we were all doing the quiz, the stress level alone would blow the roof off. So there'll be 3 rooms, and I've assigned you to a room. Why do you look at me like I have 2 heads? So you you got that, right? The 2 to 3. So if, make sure that you go to the right room, otherwise we'll get overcrowding in the rooms. So the first 30 minutes of class, 3:30 to 4. So don't be late. Otherwise you'll miss a big chunk of the quiz. It's open book, open notes. You can keep your iPad open. You can use your laptop, but just to look at slides. Don't open Excel, don't play around. It's for your own protection that I'm going to keep you from using Excel. No, so it's 30-minute quiz. So time is not your ally. So don't sit there for the first 20 minutes pondering what to do. Just get it, right? Pick a problem, get going. There will be office hours tomorrow from 5 p.m. to 7 p.m. I sent you the link for those, for the Zoom office hours. So I thought Zoom would be more flexible for that. So, if you're working from home, you have questions accumulated. I wanted to put it off as late as I could before the quiz because there's no point having office hours before you're ready. So hopefully by then you can go through past quizzes, see questions that come up repeatedly, and see if any of them need to be answered. Any questions about the quiz before we start? The first 10 or 15, the quiz is only through cash flows, so which will be done with about 10 minutes, but really the bulk of what you need is almost everything you need has already been done. 15 minutes into this class, we're going to start on growth rates, which are not on the quiz. So if you go back enough quizzes, you'll notice there are growth rate questions in the quiz. They won't be on this quiz because that was a different kind of quiz, different material covered. It'll be only through cash flows. So today, as I said, we're going to start talking about growth rates. I want to ask a couple of questions about growth to get it started. Yep. Have you looked at the past quizzes? It's exactly the same format, right? Have you ever seen a multiple choice question in my quiz? That's your answer, right? Which portion of the website? That was the 2020 online, because when you took the quiz online, you could not do it except. So maybe that's a throwback in time. So it will be free. It will be open. So make sure you show your work, because you are getting credit, not just for the final answer, but how you got there. So make sure you do show your work. The reason I don't like multiple choice questions is you can't really get partial credit. So this is actually far better than having 4 multiple choice questions. Trust me, it's all or nothing there. So this is basically show your work, try to be neat, because I'll be grading 350 quizzes and I will not be in a particularly good mood by the time I get to quiz 274. And you've scribbled on the side and the top and all over the place. I'm not going to follow you all over the page looking for where your answer is. So if you keep it neat, it's actually to your benefit, because then I can follow your work and say, this is where she screwed up or he screwed up. That's a half a point. So instead of losing 2 points because I have no idea where your work is, show your work. And if you want to have scratch paper on the side, you really don't need that much. Everything should fit on the quiz itself. So you don't need to bring any exam books or something. It'll be 4 pages. Each problem will have its own page. And you can use the back of the page if you screw up and you want to cross out what you did. Hopefully that doesn't happen. So there should be plenty of room to show your work. Any other questions on the quiz? Okay. So let's start talking about growth. I'm going to start with a question about growth that we tend to kind of think we know the answer to, but we really underestimate. People talk about the compounding effect of growth. But let's see how good your compounding instincts are, right? So don't pull out your calculator yet. You can check your answer. Let's say you have, and you can take the name of the company out. LinkedIn is no longer the appropriate. You have a company with revenues of 200 million. Let's assume you decide to give this company a growth rate of 30% a year every year for the next 10 years. I want you to guess what your revenues will look like 10 years from now with a 30% growth rate. Just give me your gut instinct. We talk about compounding. Will they be $500 million, 1 billion, 2 billion, 3 billion, or 4 billion? How many of you think we're going to end up at $500 million if you let 20? Nobody. Good. Okay. How about $1 billion? In fact, if you did arithmetic growth, it should be around $1 billion, right? What do you think it's going to be? It's actually around $3 billion. Try it out on your calculator. Okay? 200 million growing at 30% a year is $3 billion. What if I double that growth rate? So 30%, I use 60%. It was 3 billion with 30%, so it'd be around 6 billion with 60%, right? It's more like 25 billion. The reason I bring this up is often when you sit down to value a company and you like your company, you want to put in a high growth rate, right? It's a 50% growth rate. Be careful because that growth rate will create really large numbers. And you have to stop and ask, is my company's market big enough that I can have a $20 billion revenue? That's why I don't like to think in terms of growth rates. I like to think in terms of end revenues. So when you use that FCFF simple Ginzu spreadsheet, don't think of the growth rate. Look at the end revenues there. Is my company capable of delivering those revenues? So that's one thing we'll talk about is growth rates and how they compound. We'll also talk about what metric are you looking at when you look at growth? See, what are you talking about? I can look at growth in revenues. I can look at growth in operating income, growth in net income, growth in earnings per share. Which growth rate should you be using? If you're doing a firm valuation, you're estimating free cash for the firm, which of these growth rates would you need to use? First, you don't want net income or earnings per share because it's equity numbers. And so when you look at revenues and operating income, think of the conditions under which the two will grow at the same rate. When will revenues and operating income grow at the same rate? What's got to be true about margins? Margin has to be stable. If margin is stable, projecting one will give you the other. If margins are changing, you can keep moving up the income statement. When you look at growth rates, as you move down the income statement, you're going to probably see growth rates be very different. In fact, when you look up growth rates for your company on Yahoo Finance or on Bloomberg, the growth rates you're usually getting are growth rates in earnings per share. Analysts don't project growth in revenues. Very, very few project growth in operating income. Almost all of them project growth rate in earnings per share. So when you look at your valuation and you want to use a growth rate and you use that growth rate, you're using an earnings per share growth rate where you should really be looking at revenue growth or operating income growth. Finally, towards the end of today's session, we're going to talk about what it is that ultimately drives growth. And fundamentally, if you think about what drives growth, it's, what are you putting back into the business? So let's assume you have a business which has after-tax operating income of 75 million on revenues of $1 billion. Right? It doesn't plan to reinvest any money. And it'll maintain its existing assets and its existing return on capital. I've kind of given away the problem. If you don't reinvest any money and you're going to maintain your existing return on capital, what's your growth rate going to be? You maintain your existing return on capital. Your capital is not growing. You're not reinvesting. You're going to be stuck with a growth rate of 0. Or put differently, if you want to grow, what do you need to do? You either need to increase your invested capital by reinvesting more, or improve your return on capital. And today we're going to talk about both ways of thinking about growth. It's a much healthier way to think about growth because it traces back growth to what you have to do as a business. Growth is not magical. You and I don't have the power to go around endowing companies with high growth just because we like them. So as you think about your company again, you're thinking about what kind of business is it and how does it run this business? Because that's going to give you an indication as to what kind of growth rate to use. So I'm going to close up that and go back to who this person is with this. I know who that person is, and I'd like to very much meet them one day. Now, because he's always on Zoom. Hopefully on Wednesday he will be up for the exam. I will talk to him directly. But remember the last session we ended by talking about free cash flow to equity. Free cash flow to equity, I said, is net income minus reinvestment minus or plus whatever you get from cash flows or repay to lenders or repay to lenders. I want you to hold on to that thought because I want to go back to a structure I introduced at the start of this class. Remember we talked about corporate life cycles? I'm going to go through each stage in the life cycle and you tell me what you'd expect to see as free cash flow to equity. You have a startup or a very young company. Let's start at the top. What kind of net income are you going to see at a startup or a very young company? Probably a net loss, right? You're starting your business. What kind of reinvestment are you going to see at a very young company? Lots of reinvestment because you're hoping to grow. So you have negative net income, lots of reinvestment, and generally they can't afford to borrow money. There's no cash flows from debt. You're going to have negative free cash flow debt. VCs call this cash burn. It's a feature of young companies is you have cash burn. So let's say this company's business model starts to get traction. Its losses start to become profits, but it's still a high growth company. It still has a huge reinvestment need. And that reinvestment is going to be far greater than that small net profit. You're still going to have negative free cash flow equity. So as you're a growth company, lots of promise, your net income might turn positive, but your free cash flows to equity will still be negative. You keep moving. Your business model not only has traction, it starts to generate profits. And your growth starts to level off. Keyword is level off. So what does it bring you as a bonus? If your growth starts to level off, you're disappointed, but you also don't have to reinvest as much. So your profitability improves, your reinvestment drops off, and you might even be able to tap into debt for the first time, right? Some of your reinvestment can come from debt. Your free cash flow equity now has a chance of turning positive. And then you become a mature company. You now have very little growth. You don't have to reinvest much. Your existing business are throwing off profits like crazy. You're going to have huge cash flows. This is peak free cash flow equity territory. And then you go into decline and your free cash flow equity start to decline as well. But if you look at the pathway of net income and free cash flow equity, net income turns positive before free cash flow equity. It peaks before free cash flow equity does. And then in the last stages, it'll actually fall below your free cash flow equity as you liquidate yourself as a company. Sounds like an abstraction, but I thought I'd try this out on Tesla. The first time I valued Tesla was in 2013. Young startup, big money loser. So what you would see in this graph is actually my net income and free cash flow equity for Tesla every year from 2006, the year of their founding, all the way through 2021. So the green column is your net income or loss. And you can see it's a net loss, net loss. In fact, until 2019, Tesla had never made money. But in those years, look at the free cash flow equity. While you have a net loss, the free cash flow equity is even more negative, which makes sense, right? You have a net loss, you got reinvestment, you got negative free cash flow equity. In 2020, the net income turned positive for the first time. You're saying, what happened to the free cash flow equity? It seems to have disappeared. It actually was very close to zero. But remember, the net income turned positive, free cash flow equity did. Finally, in 2021, you can see net income is positive, but free cash flow equity is still lower than net income because it's still a growing company. If I track these two over time, if you're an upbeat investor in Tesla, what do you expect to see these numbers look like for the next decade? First, net income will have to continue to increase, right? Free cash flow equity will stay below the net income if they're going to grow, but it'll start catching up. In fact, one sign that Tesla has matured as a company is when free cash flow to equity finally catches up or gets close to net income. That might happen when the growth rate gets to 1 or 2%. You don't want that to happen as an investor, but think of that as a steady state. One of the indicators I use to detect where a company is in the life cycle is I look at the net income and I look at the free cash flow to equity. If the net income is running way ahead of the free cash flow to equity, is much higher, I think of it as more in its growth phase. Whether it's good growth or bad growth, I still have to make a judgment. If the numbers are starting to catch up, it's towards its mature phase. And the free cash flow to equity starts to get higher than the net income, your company is starting to actively shrink. It's becoming a smaller company. So when you think about free cash flow to equity, factor that in. Now, this table in your notes is incorrect, so I had to replace it. It's not incorrect, but I wanted to replace it with a table that I think better tells the story. So in this table, here's what I've done. I took all publicly traded companies in 2022. I got their aggregated net income across all companies, the aggregated free cash flow to equity across all companies. So think of this as potential dividends. China actually had negative free cash flow to equity in 2022. Potentially, Chinese companies should be paying dividends in the aggregate. But think of 2022, maybe there was an aberration. Then you have dividends and buybacks. And I looked at the percentage of cash flows within each part of the world that come from buybacks. Notice the outlier? The US, now 65% of all cash returned to shareholders takes the form of buybacks. That's why the dividend discount model no longer works in the US. You're focusing on a small slice of the cash flows. But it's not just the US. You're starting to see this number rise across the world. More and more companies are shifting away from dividends to buybacks. So when we talk about cash return to shareholders, we need to talk about buybacks as part of the process, or we're missing a big chunk of those cash flows. One final number, and this I think is potentially troubling, especially if you think about the US economy. Take a look at the cash flows returned, cash return to shareholders, dividends plus buybacks, 1.5 trillion. Take a look at the free cash flow to equity, 232 billion. Remember I said you can tell where a company is in the life cycle by looking at net income versus free cash flow to equity. In a sense, in countries where you start to see growth start to become close to zero or negative, you'll start to see the cash return to investors start to exceed potential dividends. You're seeing that in the US. And it's not just now, it's been going on for quite a while. So any questions on free cash flow to equity? There's one final point on free cash flow to equity, just to mop up. If you have a company which has decided on a fixed debt ratio, in other words, they tell you from this point on, 20% of all our reinvestment needs are going to come from debt, 80% from equity. And lots of companies have target debt ratios. There's a shortcut you can use to get to free cash flow to equity. So rather than go through that 6 lines that you saw before, here's what I'm going to do. I'm going to start with net income like I did before. Then I'm going to look at the equity portion of net capex. So in other words, instead of counting the entire net capex as reinvestment, I'm going to count only the 80% that comes from me as an equity investor, and count only the portion of the 80% that comes from me for working capital. I have a shortcut to free cash flow to equity. The reason this works is I'm implicitly assuming that any debt that gets repaid will get repaid with new debt that's raised, and that new debt will be taken on as I grow as a company. It keeps my debt ratio stable. So when you think about free cash flow to equity, again, remember it's a post-debt cash flow, and how much you borrow can affect that free cash flow to equity, which opens a door to one way in which you can increase the free cash flow to equity. And companies often walk through this door thinking this is a free lunch. So I'll illustrate this with a very simple example. Long time ago, I computed the free cash flow to equity for Disney. So in 1997, the net income was 1.4533 billion. Their debt ratio was about 24%. So 76% of whatever they reinvested came from equity, and they seem to have settled into that. So let's say I computed the free cash flow to equity. There's my net income. I subtract out 76% of net capex and 76% of change in working capital. I end up with a free cash flow to equity of 704 million. That year, they paid out 345 million dividends, showing that they held back on cash. I'm going to play a little game here, and you tell me what I'm missing. The debt ratio that you see of 24%, let's say I made it 30% or 40% or 50%. As I raise the debt ratio, what's going to happen to my free cash flow to equity? So debt ratio goes from 24 to 40%. Remember, net income is still my net income. It's still there. But now I'm going to get only 60% has to come from equity. So the more I raise from debt, the less I need to reinvest as equity investors. I have more cash flows left over for myself. Like, there's the free lunch. It looks like if I just raise my debt ratio, my free cash flow to equity goes up as my debt ratio goes up. This seems like every LBO guy's dream, right? You go borrow money, your free cash flow to equity shoots through the roof, at least on a per share basis. What can go wrong? Isn't the value of equity the present value of free cash flow to equity? So if a higher free cash flow to equity, doesn't this mean my equity should be worth more? What do I discount the free cash flow to equity at? What's the discount rate I use? By now, you should have done enough review on the quiz, get that right. Should I use a cost of equity or cost of capital? Cost of equity, because it's free cash flow to equity. And what's the key number that determines how high or how low the cost of equity is? It's not the risk-free rate and the equity risk premium. They have nothing to do with my company. It's my beta, right? And what beta do I use? A levered beta or an unlevered beta? A levered beta. And as I borrow more money and I make my free cash flows to equity higher, what's happening to my levered beta? There's my cost of equity as my debt ratio goes up. So as I borrow money, I will have more free cash flow to equity because I have to reinvest less as an equity investor, but I'll also face more risk as an equity investor. I'll have a higher cost of equity. So which effect do you think will dominate? The cash flows are going up. The discount rate is also going up. Let me give you the choice and you tell me which of these choices would best describe what will happen to this company if it borrows more. The first is that increasing leverage will increase value because the cash flow effects will always dominate the discount rate effects. Think through that. If that is true, then what should happen? Every company should be at 99% debt. The second is increasing leverage will decrease value because the discount rate effects will always dominate the cash flow effects, in which case, if that's true, nobody should borrow money. Maybe increasing leverage will not affect value because the risk effects will be exactly offset by the cash flow effects. Does that sound mildly familiar? Remember in your corporate finance class, you talked about Miller, Modigliani? You don't remember them, right? You probably had it in passing. But somebody remind me, what does the Miller-Modigliani theorem say? It doesn't matter, right? In a Miller-Modigliani world, it's C that'll apply. Whatever you gain by increasing leverage, and don't dismiss it too quickly. There are some companies where leverage is in fact a neutral factor. Changing it will not affect value. And there's a fourth statement, which is increasing leverage can increase value for some firms and decrease value for others. I fall on D. And in fact, I put up my latest data update on debt. If you get a chance to review it, because it's a good review of your debt sessions from corporate finance, of how debt plays out in value. Because too often in practice, people look at one side of the equation. So people who look at only the cash flow or the return on equity side, those private equity investors tend to borrow way too much because they're not factoring in the risk. But there are other conservative companies that look at only the downside of debt. They factor in the risk it brings and they don't factor in the cash flow effect and the return equity effect. It's a trade-off. I'm not trying to convince companies to borrow more, but borrow less, but they need to think about the trade-off in terms of will increasing the debt ratio at my company actually increase its value for its equity investors. Any questions? So let's talk about growth. I'm going to set the table for growth by first arguing against the notion that growth is always a good thing, right? Now, how deeply entrenched that is. I mean, when have you heard a CNBC analyst get on and say, I really like this company because it has low growth or negative growth, right? So at least if you listen to these people, they always seem to think higher growth is better than lower growth and lower growth is better than negative growth. That's not true. Growth is a double-edged sword. The good side of growth is it makes your revenues grow, it makes your income grow. That's a good side. The bad side of growth is you got to reinvest to get that growth, right? You got to put aside money. It goes into CapEx and working capital, reduces your cash flows. Whether growth is good or bad will depend on whether the good side overwhelms the bad side. And we use a very simple metric, and we'll come back to this. If you can earn a return on capital over the long term that exceeds your cost of capital, you're going to create value from growth. If you earn roughly your cost of capital, you're running in place with growth. It's not adding or destroying value. And if you earn less than your cost of capital, you're actually destroying value as you grow. That's going to become the basis for this entire session on growth, is to talk about good growth as opposed to bad growth, rather than say any growth is good. Therefore, I'm going to go out and grow as a company. So let's look at the ways in which you can estimate growth for your company. By now, I hope you've already picked a company. I'm not going to nag you anymore. I've stopped looking at your master list. Obviously, I'm never going to fill in the name of your company until I start saying 5 points for putting the name of your company in. You're probably waiting for that point to come. And it'll come, because I need the names eventually. But let's say you're sitting down trying to think about, hey, I want to estimate growth for my company. How do I do it? Let's set up the 3 ways in which people try to estimate growth. And there are only 3. Everything you do has to go through one of these 3 pathways. One is you look backwards, right? You look at the past. You say, how fast has my company grown last 3 years, last 5 years, last 10 years? It's called historical growth. It's natural. That's where we start. The second is we outsource. You know what I mean by outsource? Let me see if somebody's told me what growth rate to use for IBM, what growth rate to use for Meta. It takes the weight off your shoulders. It's not that their growth rate is better, but now you can blame them if something goes wrong. And in the context of valuation, there's actually a group out there that you think of as experts. Equity research analysts, that's all they do. They track these companies. They've given me a growth rate. I'm going to use that growth rate. So the second approach to estimating growth is you look at analysts, you look at managers, you try to get growth rates from them and say, they must know more than I do. Therefore, I'm going to use their growth rate. So you can look at the past, you can look at what other people are forecasting, or you can start with the business itself, the company itself, and say, I'm going to look at how well my company is run, what it reinvests and how well it reinvests. And if you can answer those 2 questions, how much it reinvests and how well it reinvests, I'm going to give you a very simple mechanism for coming up with growth for your company. It's called a sustainable or fundamental growth. So let's start with historical growth. The conventional wisdom often is, set the speaking language to English. I thought I was speaking in English, but I guess I wasn't, right? No. The conventional view of historical growth is that, you're looking at the past, you're going to come up with a growth rate. So I'm going to start by looking at historical growth rates and why they're not as clear cut as they look from the outside. So when you try to estimate the historical growth for your company, here are some of the choices you'll have to make. First is, are you going to compute an arithmetic average or a geometric average? Part of you is already saying, who really cares? You're going to be amazed at how big the difference is when you look at growth on an arithmetic average basis or when you look at a compounded average. In some cases, I've seen people even bring in statistical tools like regressions, overkill in my view, to try to estimate growth. So there's the mechanics of how you're estimating growth. Second, the growth rate you get for your company can very much be a function of the period you look at for your company. I'll give you a very simple trick you can use to make the growth rate for your company look high. Pick a really bad year as your base year. Take a hotel company, you make 2020 as its base year, it's going to have 250% revenue growth since then. Why? Because all the hotels were closed. It's also going to depend on the metric you use to estimate the growth. Is it revenue? Is it operating income? Is it net income? Is it earnings? But you can get very different numbers. So growth rates you get can depend on the method you use to compute the growth rate, the time period, and the metric you use. And in some cases, you're going to hit a brick wall and not even be able to estimate a growth rate. You say, why would I, With revenues, you can always estimate a growth rate. But let's say you're looking at growth in earnings per share. And let's say you had minus $1 as your earnings per share last year and plus $1 this year. First, was this a better year than last year? Let's start with the easy question. You went from minus to plus. That's good, right? Minus to plus is good. But then when I asked you, what growth rate did you have this year? Think about it. How do you come up with a growth rate when you go from minus to plus? We're going to look at tricks people play, but they're tricks. They're not really dealing with the fundamental problem. And I'm also going to talk about the compounding effect. What happens if you're not careful about taking past growth rates and projecting them out to the future? So let's start with the first question, arithmetic versus geometric averages. How much does it really matter? So this is a company called Motorola, a semiconductor company, late 90s. I estimated the growth rate in revenues, EBITDA, and EBIT. So basically, it took 6 years of numbers. And the first way I estimated growth was an arithmetic average. What's an arithmetic average? You compute the growth rate every year, and you take the simple average of the growth rates. So the arithmetic average growth rate in revenues over the 5 years is 7.08%. The geometric average, where you take the starting number and the ending number, and you look at the growth rate between those two, is 6.82%. You're saying, so they're pretty close. And revenues, they are pretty close. But look at arithmetic and geometric averages for EBITDA. The arithmetic average is 10.9%. The geometric average is 5.39%. If you look at EBIT, the arithmetic average is 42.4%. The geometric average is 4%. Notice the arithmetic and the geometric averages are diverging as I move down the income statement. This is almost always going to be true. And here's why they're diverging. Remember, the two arithmetic and geometric averages will converge. Only one condition is met, which is the growth rate is the same every year. In other words, if there's no standard deviation in the growth rate, your arithmetic and geometric averages will be the same. The greater the standard deviation in the growth rate, the more volatile growth rates are on a year-to-year basis, the bigger the difference. As you move up the income statement, growth rates become more stable. Revenues don't go 500% minus 100%, but earnings can. That's why arithmetic and geometric averages tend to be closer for revenues and much more divergent when you look at net income. It gets worse with earnings per share. So if you're saying, which one should I use? A geometric average is a much more realistic estimate of growth. I don't even know why we compute arithmetic averages still. But geometric averages are much, much more realistic because you're talking about growth in earnings over time. A compounded average better captures that. Any questions on arithmetic versus geometric averages? Now let's take that scenario where you go from negative to positive and talk about what does that tell us. Let's say you're looking at Time Warner in 1997. In 1996, they had negative earnings per share, minus 5 cents. In 1997, their earnings per share went to 25 cents. I just put it into my Excel and said, compute the percentage change. Here's what it did. It took the change from last year to this year, which is 30 cents, and divided by earnings per share last year. And I said, I got a minus 600% growth rate. First, does the sign even make sense? I went from negative to positive. It's a good year, right? But look at the growth rate. It says terrible year, minus 600%. You're saying I can fix that. Let me make the minus into a plus. You can do that. And some people do that. They use the absolute value of the earnings, the denominator. Neat little trick, but it's kind of meaningless. The second is, what's giving you the negative number here? The denominator is negative, right? So here's the second way mathematically you fix it. Rather than divide by last year's earnings per share, you divide by the higher of the two numbers. What a neat little trick. Now you've gone from minus 600% to plus 120% because the denominator will now be 25 cents. My bottom line, though, is none of these numbers really make sense in terms of forecasting future earnings per share. If you have earnings going from negative to positive, you cannot estimate a growth rate. Might as well just say, there is no historical growth rate I can use. I can see trend lines. I'm moving from negative to positive. That's good, but kind of move on. So the assumption you can always get a past growth rate is not true, especially when you have numbers that go from negative to positive, positive to negative, because growth rates can't work with sign changes that well. So, as I said, you can play all kinds of tricks with negative earnings, and one trick is use the absolute value, use the higher of the two values. None of these numbers, though, have any meaning, any resonance in terms of forecasting future growth. So my suggestion is start with your history, see if you can compute growth rates and revenues, operating income, net income. You might never use them, but at least be aware of what's my company growing at, because it's the starting point, the platform from which you're going to tell the story about future growth rates. One final point about historical growth. Be very careful, though, even if you feel sure about past growth, in extrapolating that growth into the future. Go to Callaway Golf. What is the most famous product? What was the product that put them on the map? You say, sorry? No, before the golf ball, they had a golf club called the Big Bertha. That was their claim to fame. The Big Bertha was what launched them into. Now, of course, they have the golf ball business. Right? So this was a company that came out of nowhere and created a golf club. And the advantage of golf is everybody thinks that if they had a better golf club, they would be Tiger Woods, right? This is how you sell people on it. So, they sold the golf club. They succeeded. This was in 1997, was valuing the company in class. They had 122 million in net income, up from 1.8 million 5 years before. So the compounded growth rate over that 5-year period was 102%. It's not even arithmetic average, geometric average growth rate. So let's say 97, I look at the last 5 years, this is a great company. It's got 102% growth rate. I'm going to project 102% growth rate for the next 5 years. See what happens. Basically, if my story comes true, we'd all have to buy Big Berthas and put them in our closets, even though we don't play golf, because I'm giving the company $4.1 billion in net profit by the time I get to 5 years out. 122 million growing at 102% a year is essentially going to explode out very, very quickly into numbers you cannot sustain. If those of you valuing young companies, especially companies with this history of really high growth rates, be careful about not taking the last 5 years of growth, which might be 70%, extrapolating on a much bigger base now for the next 5 years, because your company might not. This is like the example we started the class with. Be careful about extrapolating past growth, even if you think it's a reliable number into the future, because scaling up is hard to do. Is that a song? I think it's breaking up is hard to do, but somebody should sing a song, scaling, and they should play it out loud in every equity research, office in the world, because analysts constantly assume growth rates that you cannot assume as a company scales up. So now let's talk about using outsiders estimates. The most common source for growth rates is for appraisers of private companies. Does anybody know? How do appraisers of private companies come up with growth rates for their companies? They ask the managers of the company what to use as a growth rate. And the logic is impeccable. They say the managers know more about the company than I do, so I'm going to trust their growth rates. And it's true, they do know more, but they have a problem. They're biased, right? They have a story to tell, and they're going to give you a high growth rate. They're not lying. They're just delusional enough to believe their own stories. But lots of appraisers, we ask them, where do your numbers come from? They use management growth rates. And in public companies, you ask people, where do you get the growth rate for your company? Their answer is, they got it from equity research analysts. Because that information is actually public information. You can get estimated growth for the next 5 years for your company. You go on Yahoo Finance, you can look up that growth rate. You go on Capital IQ, you can look up that growth rate. So you can look up the growth rate for your company, earnings per share for the next 5 years, even in revenues for the next 2 years. And here's the logic that leads people to trust those analyst forecasts. Remember, I talked about sell-side and buy-side analysts. Sell-side analysts, the analysts that you see at investment banks who track 15 or 20 companies for the rest of their lives. Buy-side analysts work at Fidelity or T. Rowe Price, and they track a much bigger set of companies. They move across sectors. But sell-side analysts dedicate their life to a sector. So you picked a company in that sector to value. Your reaction is they do this all their lives. They just track these companies. They must know more than I do. And a significant portion of every analyst's time is forecasting earnings per share. So their forecast of earnings per share must be much better than the forecast the rest of us make because of how much time and resources they bring to the game. So I'm going to start with that. We're going to look at earnings forecasts from analysts and how much better they are than the rest of us because they bring in all this additional ammunition to the game. So there have been several studies that look at analyst forecasts relative to time series models. In time series models, you just take past data and extrapolate. A computer is going to do it. It's not even ChatGPT. This is pre-ChatGPT. You basically take time series data, you project out there. Analysts should be able to beat that hands down, right? They have all of that data plus access to management. They spend all their time doing research. They talk to all kinds of experts. So these studies look at whether analyst forecasts beat time series models, a very minimal test. And I'll give you the good news first. If you look at 1 quarter ahead forecasts, which is next quarter's earnings, analysts are better than time series models, small blessing, but not by much. The way to think about this is if you get perfect forecast, you get a very low, your numbers are, so if your forecast is always exactly on the board, you should get a standard error of 0. None of them have a standard deviation of 0. In fact, analyst forecasts are slightly better than the forecast from time series models if you look at 1 quarter ahead forecasts. If you go to 2 quarter ahead forecasts, even that mild advantage seems to disappear. By the time you get to 5-year or 1 year, there's really no difference between just using the past data and using an analyst forecast. It's kind of an incredible waste of resources, right? We're spending hundreds of millions of dollars. These equity research analysts turn out reports, and their primary focus, which is forecasting earnings per share beyond 1 quarter ahead, they don't seem to do that good a job. It's been a mystery. What is it that's happening? Why aren't they better? So to answer that question, I'm going to focus in on a subset because, you know, you present this evidence, and I have, to Equity Research Analyst Conference. They all look at each other and say, well, that's not us. It's the guys outside the room. We're much better forecasters. You're focusing on all analysts, and there are a lot of crappy analysts. None of them are at this conference. If you focus on the very best equity research analysts, you'd get much better answers. So there are studies that do that. You know that there is just like in football, there's an All-America team. There's an All-America team of equity research analysts. Institutional investors have been picking these analysts now for maybe 40 years. So they go into each group, energy group, they pick the All-America analyst for this year is so-and-so from Goldman Sachs, so-and-so from Morgan Stanley. If you're an equity research analyst, this is the pinnacle of your life. The minute you become an All-America analyst, this now becomes part of your name. You're no longer Joe Brown, equity research analyst. You're Joe Brown, All-America equity research. That's how you introduce yourself to your spouse, to your children. You say, from now on, call me All-America because I'm an All-America analyst. Because it increases your income by millions of dollars once you become an All-America analyst. So these are the very best of the analysts, right? So there are studies that look at these All-America analysts and they ask a very simple question. They ask actually 2 very simple questions. One is, are these guys much better than everybody else? Is that why they became All-America analysts? And second, are All-America analysts forecasts better than the forecasts of this unwashed herd that forecasts earnings? And the answer is actually very surprising. You know that in the year before these analysts become All-America analysts, their forecasts are actually a little worse than the forecasts of average analysts. So they become All-America analysts. It's not because of their forecasting accuracy. It must be something else. You know, All-America analysts are based on votes from people. So if I give you 15 analysts, and these are all people in the finance, and you get to pick a name, you're going to pick based on who you see on CNBC or who you see. So the more visible you're as an equity research analyst, the more likely it is that even if you're a terrible analyst, if you get quoted all the time, so the year coming in, they're actually a little worse at forecasting than the typical analyst. Then something magical happens. They get picked as All-America analysts, and the year after, they magically become a little better at forecasting earnings than everybody else in the game. What do you think happens? Self-esteem rises and they become better forecasters. What do you think happens when you become an All-America analyst that makes you a better forecaster of earnings than the typical analyst? Because so tell me how this plays out in practice. When you say confirmation bias, I'm actually looking at their earnings forecast. Their actual earnings are getting more accurate, right? So that isn't just a subjective judgment. They're actually getting better at forecasting earnings after the choice. So it can't just be confirmation bias where I just look at the name, All-America analysts, their forecast must be better. They're actually getting better in terms of being closer to actual earnings. Yes. It's not even, that's a different issue, which is the price effect you have goes up. That effect you can explain by the fact that if you're an All-America analyst, Wall Street Journal picks you up more often, you get a bigger effect. But the earnings forecast itself. Remember I said your name now becomes Joe Brown, All-America analyst? So let's say you play the role of an equity research analyst. Remember, you're not supposed to get information from the firm directly. The SEC is actually very tight on what kind of information a company can reveal to analysts. But you get little smidgens of information, little rumors. So you're Joe Brown, just equity research analyst, you call the company, they blow you off. There's so many analysts calling, who cares? You're Joe Brown, all-America analyst. CEO comes on the phone and says, I can't give you specific, but our inventories are running low. Read into it whatever you want. Your access to information magically becomes better when you become an all-America analyst. It's a fact that people think that you can be the conduit for revealing this information to the market. And it is true. And the point made about the price effect of your recommendations becomes much greater when you become an all-America analyst. But here again, there's a disparity between buy recommendations and sell recommendations. Buy recommendations, when all-America analysts put them, cause the price to go up, but the price increase disappears very quickly. In other words, it seems to be all liquidity, people coming in. But sell recommendations, when they come out, not only have a much bigger impact on the price, they have a much more lasting impact on the price. It's kind of weird, right? Buy recommendations don't leave any lasting impressions, but sell recommendations do. Why do you think that is? Sticky, is that the word you used? Or stinky? Sticky, okay, sticky. But both drive actions, right? Buy people buy, sell people sell. So I'm not sure stickiness alone explains it. First, remember the numbers I gave you for buy versus sell? It used to be 20-1. It's now 9-1. So first is sell recommendations are red. The very fact that there's a sell recommendation indicates that there must be something freaking you out. So the first is that it's unusual to get a sell recommendation. Second, remember you're burning your bridges with sell recommendations. So the fact that you put out a sell recommendation must indicate that you feel so strongly that you're willing to put the sell recommendation. So buy recommendations come out, they have a price impact, the price impact disappears. Sell recommendations come out, they stick, and you see the prices stay lower. So I've wrestled with this. Too many people from my valuation classes have ended up as sell-side equity research analysts. I try to talk them out of it. I never quite succeed. And some of you will end up as sell-side equity research analysts, but no. So this is for you when you get out there as sell-side equity research analysts in terms of what you might be able to do to fix, because there's a problem, right? We're spending millions of dollars in sell-side equity research, but it's not credible. Nobody really cares what it is, and it doesn't seem to be having any impact on value. So I took a closer look at why sell-side equity research is in the trouble that's in. And as I see it, there are pretty much 5 problems that I can isolate. First is tunnel vision. The nature of sell-side equity research, as I described it, is you're put in a sector and asked to look at 15 companies and act like the rest of the world is not there. That's not healthy. Nobody in market should be looking at an individual sector and forgetting the rest of the world, because then when everything in your sector gets trading at 50 times revenues, you don't think it's unusual. Everybody pays 50 times revenues. What's the big deal here? It's tunnel vision. What's the solution to that? What do we need sell-side equity research analysts to then? We need to actually rotate them, right? Move them across sectors. I know you're going to give up some expertise when you do it, but this notion of staying sector focus is, I think, getting in the way of good equity research. Second is there's a whole lot of lemmingitis in sell-side equity research. One of the things you'll notice with the sell-side equity research analysts is they'll revise earnings estimates upward if they think positive. You see one so in the Wall Street Journal, keep your eye on an earnings revision that's upward. And you get a whole host of earnings revisions upward in the next 3 or 4 days as other equity research analysts rush to join. Third, there's a version of what I call the Stockholm syndrome. You heard of the Stockholm syndrome? Stockholm syndrome was, I think, concocted by some psychiatrists in the 1970s when they noticed that people who were getting kidnapped after a while started identifying with hostages, were identifying with the hostage takers rather than the people trying to rescue them. It's a Stockholm. You're saying, what's that got to do with equity research? If you think about equity research at its core, what are you supposed to do? You're supposed to ask deep questions of companies and be an objective assessor of what a company is worth here. At some point, though, equity research analysts seem to forget that they're supposed to look at companies as objective outsiders. They become insiders. They become defenders of the company. Why? Because they play too much golf with the CEO. They get to know the manager. I mean, let's face it, if you get really, really friendly with the top management of a company, it's very difficult for you to be objective. You're one of them. There's a lot of factor phobia in equity research. A lot of tables, but the numbers never get used to any productive use. A lot of storytelling without an anchor in numbers. And finally, and this is less of a problem than it used to be in the US. In many investment banks, sell-side equity research. In the US, almost every investment bank, sell-side equity research is not a revenue center. You don't charge for your research. You give it away for free. So why do you do it? Because you expect other business to go through the investment bank. Which means you got to constantly think about, if I put out the sell recommendation to the company, what will the rest of the investment bank think of me? Will I get a call from the CEO or a managing director saying, come in and talk to me? Because this is a company we're going to take public in 6 months. It's okay. Yeah. So, in fact, last week I was in my room doing a session for Google managers, and I have a Google Wi-Fi. So I kept saying the word Google, and she would keep piping in saying, I can't quite understand what you're asking. I'm not asking you anything, just shut the heck up, right? So the problem with, I have Siri on my phone, I have Alexa at home, and I have Google in my office at home. So I called them by the wrong name. They'd never answer. So I asked Google to do something, calling it Alexa, no response. Call Alexa, Google, no response. So one of these days I'll get the names right. But I think sell-side equity research is in trouble. It needs to be reformed, to be fixed. So if any of you are going to sell-side equity research, this is a long fight to be fought. Initially, you're going to be put in a sector. You'll be asked to follow 15 or 20 companies. Try not to develop tunnel vision. Keep your perspectives open. Look at the rest of the market. Be aware of what's going on. And you will feel pressure from, if you work at an investment bank, because there'll be other business the investment bank has. You can't fight it alone. You got to figure out some kind of mechanism that you can be at least reasonably objective, even though there's pressure on you not to be so. Okay. Yes. You're following the entire sector. You won't have a job tomorrow if you put a sell recommendation in entire. This is your entire sector, right? So if you say sell everything, remember, most of your clients are long only clients, right? I mean, unless you have a lot of hedge funds as clients. You could, if you're not a sell-side equity, so then you'd have to be a macro analyst. There are sector analysts whose job it is. And there it's easy. You can say buy this sector, sell this sector. So there's research at the sector level or even at the market level. You can sell entire geographies, sell all Indian stocks, buy Chinese stocks. But at the individual sell-side equity research level, it's very difficult to put a sell recommendation. So I'll complete this section by stating 3 propositions about analyst growth. First is, if you think analysts have access to some private information that you don't have, let it go. In the US, they really don't know much more than you do. You have capital IQ, they have capital IQ. You read the earnings report, they read the earnings report. You want to sit on an earnings release, you can sit on an earnings release just like they can. The investment world has become a lot flatter over the last 40 years. They don't have information you don't. In other markets, it might be different. There are some emerging markets where equity research analysts have access to private information, inside information that you and I don't. But in the US, there's far less private information. When there is private information, remember, it's coming from one source. It's coming from the company. You're saying, so what? It's true. Company information is based on more basis. They know more about the company, but company information is by its very nature biased. It also explains why some analysts, like all America analysts, have an advantage over others. Why, if you work at Goldman Sachs, you might have an advantage over somebody who works at Jefferies, because companies think that if they release the information to a Goldman Sachs analyst, you get a bigger market. And finally, there is value to knowing what other people are forecasting. I'm not saying don't look up what analysts are forecasting for your company. And if your growth rate is 5% and analysts are projecting 25% growth for your company, you might want to stop and say, is there something they're seeing that I'm not? They might not, but it's worth asking that question before you throw that growth rate over. So you got historical growth, you got analyst estimates of growth, which brings us to the third way of thinking about growth, which is based upon what the company does. I'm going to set up a very simplistic example to illustrate this whole idea of sustainable growth. I'm going to start with a company that is $1 billion invested in existing projects on which it's making a 12% return. So right now it's making $120 million in earnings. Let's assume this company goes out and invests in new projects, 100 million new projects on which it also makes a 12% return. It's mathematically, if you look at the return they're going to have, after that investment, they're going to have 132 million. Think of where the extra 12 million came from. The extra 12 million came from the fact that they invested 100 million new projects and earned a 12% return. So when you look at the returns, the earnings that a company makes, it comes from investments earning a return. If I converted that into a growth rate, you can actually see that that 100 million I put back as a percentage of their earnings is what I'm reinvesting, 83%, and the 12% return that I make on the investment, take the product of those two, I get the growth rate that I saw in the company. The growth rate for a company where returns on capital are stable are coming from how much it reinvests, the reinvestment rate, and how well it reinvests. That's the core of sustainable growth, that ultimately growth comes from reinvesting more and reinvesting well. But once in a while, you can get growth without reinvesting, right? If I take the 12% return that I earned in the company and made it 13%, I make my existing assets more efficient, I'm going to get growth. I'm going to call that efficiency growth. We're going to talk about both types of growth. You can get growth from reinvesting more. You can get growth from becoming more efficient. But here's the big difference. Growth from reinvesting more, I can keep doing over and over for the rest of eternity. I might have to grow at a lower rate, but I can keep doing it. Growth from efficiency, you're going to run out of steam sooner rather than later. So if you tell me that for the next 5 years, you're going to get 6% of your growth from efficiency, I'm going to say that's okay. But you say forever, I'm going to get a 6% growth rate forever by becoming more efficient, that's not going to fly. So I'm going to set the process up as the product of how much you reinvest and how well you reinvest. So this entire next section is going to be about how do you estimate what a company is reinvesting and how well it's reinvesting. So I'm going to go back. Yeah. When you say stimulated, tell me the mechanics. What does that mean? The revenues are going up because people are buying more of your product. Now, do you have to build capacity to build that product? I mean, that'll explain why my revenues will go, but but you have to produce the product, right? So if you still have to increase capacity, the mechanics will still be there, right? I still have to reinvest to get that growth, because even though there's the demand for my product out there, unless I can produce the product, I can sell the product. Now, it might help that the market is growing, that I can do it with much better return. So maybe that's the bonus I get. It's a good business that's growing. The smartphone business 10 years ago, I can grow with a very high return on capital because I'm getting a buffer. I'm essentially getting the capacity to grow at high returns. As the market starts to slow down, those returns might start to come down. So the reinvestment rate times return on capital is going to apply no matter what kind of business you're in, but it's easier in some business than others to get high growth. So let's talk about how we measure reinvestment and how we measure the quality of investment. And I'm going to go back to the 3 ways you can do valuation. You can focus on, if you think about it, you can focus on earnings per share and you can focus on net income, or you can focus on operating income. You use earnings per share when using the dividend discount model. Use net income when you're doing the free cash flow equity model. You're using operating income when you do free cash flow the firm models. In all 3 cases, I'm going to estimate reinvestment. With each one, notice the subtle difference in how I estimate reinvestment. When I do earnings per share, I estimate reinvestment as the retention ratio, which is whatever I don't pay out as dividends is what I'm reinvesting. Okay? So if I have a 40% payout ratio, 60% is my retention ratio. That's with earnings per share. When I go to net income, I can no longer use the retention ratio. I've got to do my dirty work of saying, how much is this company actually reinvesting? I'm going to capture that with the CapEx minus depreciation plus change in working capital. And to the extent that I use debt, I'll factor that in. I look at what's called an equity reinvestment rate. How much of my net income am I putting back into the business? When I'm looking at free cash flow to the firm or operating income, I'm going to look at reinvestment as a percentage of after-tax operating income. So with each one, I'm looking at how much the company is putting back, but how I define what it's putting back varies depending on looking at earnings per share, net income, or operating income. That answers the question, how much am I reinvesting? How well am I reinvesting? If I'm looking at earnings per share, I'm going to measure it with the return on equity because earnings per share is equity earnings. I divide net income by book value of equity. If I'm looking at net income from non-cash assets, I'm going to look at non-cash return equity. What's non-cash return equity? I look at the portion of net income that comes from my operating assets. So I remove any income that I get from cash. And in the denominator, rather than look at book equity, I look at book equity net of cash. It's non-cash return equity. And when I look at what I'm generating as a return to the entire firm, I look at return on capital or return on invested capital. This is one of those things where you'll see multiple terms floating around: return on invested capital, return on capital employed, return. In my view, they're all the same. People dance all kinds of dances, acting like they're different, but ultimately you're measuring the same thing. You're looking at your after-tax operating income as a percentage of overall invested capital, which is book value of equity plus book value of debt minus cash. I've said this before, but I'll re-emphasize, this is the only place in finance where we use book values in computing accounting returns. When we do levered betas, cost of capital, everywhere else it's market value. This is the only place we use book values because we look at what's actually invested in projects. We're trying to get a measure of how much am I making on that invested capital. So to get growth, I basically need how much are you reinvesting, how well are you reinvesting? So I'll take you through a few examples so you can see this play out. I'm going to start easy and look at a bank. And in this case, I'm going to try to estimate expected growth in earnings per share. So this is way back in time, when I in 2007, 2008, I was looking at Wells Fargo. I wanted to get a growth in earnings per share. Growth in earnings per share, you measure what you reinvest with the retention ratio and how well you reinvest with the return equity. That equation, though, puts a cap on your growth rate. What's the highest retention ratio can be? What's the lowest payout ratio you can have as a company? 0, right? So the highest retention ratio you can have is 100%, which means your growth in the long term can never be greater than your return equity. So if you have a 12% return equity, don't ask me for 25% growth in earnings per share. It's just not going to happen. So retention ratio times return equity. So in 2008, and I used this for Wells Fargo, the return equity was 17.56%. This was before the crisis. I'm doing it intentionally to show you one of the dangers of what happens when you look at just last year's numbers. 17.56% return equity. The retention ratio was about 45%. So basically, whatever retained earnings they had divided by the net income. You take the product of those two numbers, the expected growth rate you would have for Wells Fargo, if they can sustain the return on equity and retention ratio they had last year, would be about 8% a year. This was June of 2008 when I did this. Then, of course, in September of 2008, we had the banking crisis, where effectively we all woke up to the reality that banks had overreached. And one of the things that came out of the crisis is the regulatory authorities actually decided that they were not going to let banks continue the way they were. They were going to increase capital requirements. You know what that means for your return equity, right? If the same net income and I require you to maintain more capital, it means more equity, your return equity is going to go down. So when you look at last year's return equity and retention ratio, you can get a measure of growth, but remember, to use that growth rate, you're also implicitly assuming that they can keep doing what they're doing. So this approach, it's all about having a high return equity, right? High return equity will give you a much higher growth rate for the same retention ratio. So how do you end up with a high return equity as a company? What are the two pathways to ending up with a high return equity? How does Apple end up with a high return equity? Takes great projects. It's so hard, though, to find that. There's another way you can end up with a high return equity with taking average projects. Real estate people do this all the time, which is you go out and borrow money at a rate lower than what you can make on your projects. And the more you borrow, We saw that with the free cash flow to equity calculation, right? It's a mixed blessing. You're getting a higher return equity, but you're also getting a higher cost of equity. One of the things you can do with your company is you can compute the standard return equity, net income divided by book equity. So it'll give you a number, 23%, 24%. But you can also then follow up and say how much of that 24% is coming from great projects and how much of it is coming from my use of leverage. And there's actually an equation that you can use to do this. You start with the return on capital. So if you compute the return on capital in the company, start with that. The effect of leverage is actually a very simple one, because when you borrow money at 5% and take projects that make 10%, that 5% difference goes to your equity investors. So that's what's in the brackets, return on capital minus cost of debt. And then you multiply it by how much debt you use. This is actually a return equity calculation I did for a company that used to be called Brahma. It's now called Ambev. It's a Brazilian beverage company. And I did this in probably 97, the first time I went to Brazil, and I got a return on equity of 31% for the company. And I was surprised it was so high. So I broke it down. It had great projects, 19.91%, but about 11% of their return on equity came from the fact that they were heavy users of debt. They were using debt to pump up their return equity. So when you look at your company and you see a high return equity, it might be worth kicking the tires and making sure it's not coming from using leverage. Because as an investor, you'd rather have a high return equity, the Apple way of taking great projects, than a high return equity driven by leverage. So that's growth in earnings per share. Let's talk about growth in non-cash net income. When you think about growth in non-cash net income, you've got to shift your focus away from retention ratios. You've got to actually look at what a company actually reinvests. And we know how to do that, right? After cash flows, it's CapEx minus depreciation plus change in working capital. And if you're looking at equity reinvestment, the equity portion of that number. So I'm going to compute my reinvestment as net CapEx plus change in working capital, net of the debt portion of it, divided by the net income from non-cash assets. So let's pause right there. The retention ratio, the lowest value you can have is 0%. The highest value you can have is 100%, right? Equity reinvestment rates are not bounded. Can your equity reinvestment rate be greater than 100%? Absolutely. But then what do you have to do? You have to raise fresh equity. That's why it's not a per share number. Can your equity reinvestment rate be less than 0? Can you have a negative equity reinvestment rate? Take a look at the equation. Yeah, right? What kinds of companies, if your depreciation is greater than your CapEx and you don't have much in working capital needs, you can end up with a negative. So the first thing to remember is now you're abandoning the 0-1 constraints. You can have a negative equity reinvestment rate if you have a shrinking company. You can have a equity reinvestment rate of 200, 300, or 400% if you have a company that's growing massively. You get much more flexibility. And when you talk about return equity, now you're focused only on the portion of your equity that's not invested in cash, because you know exactly what you make on cash. The T-bill rate or commercial paper rate, you're focusing on the rest of your equity. So rather than focus on retention ratios, it's kind of a bludgeon where you take everything that's not reinvested and treat it as going back into the company. And look at overall return equity, you're looking at the portion of equity that's invested in your operating assets and saying, am I taking good projects? So the example I'm going to use for this is Coca-Cola in 2010. And some of the numbers are going to surprise you. Their equity reinvestment rate was only 8%. If you look at their net CapEx and change in working capital, basically they reinvested $957 million net of debt. And as a percentage of the net income, that's about, that's only about 8% of the net income. You're saying, how quickly can a company with an 8% equity reinvestment rate go? Well, the saving grace was the return on equity. If you look at non-cash return equity, was 64%. There's a simple reason for that. Coca-Cola, about 40 years ago, spun off their bottling plants. The biggest part of Coca-Cola, the most capital-intensive part, were the bottling plants. They spun it off, made it a separate company. So those of you buying Coca-Cola shares, I've seen this mistake made before. They buy the wrong Coca-Cola. They buy the bottling company rather than the parent company. And the bottling company is a very boring, low margin business because it basically sell to one customer, Coca-Cola. So Coca-Cola is all syrup, which costs them almost nothing to make. The return equity reflects that. It's a very, very, very profitable company in terms of return equity. The expected growth rate, if you take the product of those two numbers behind this participant seeking to change, let me check to get that off there. is about 5%. So as we move from earnings per share to non-cash net income, you can see I'm trying to do the same thing. How much am I reinvesting? How well am I reinvesting? And try to bring them together in one number. Last, and I'll end with this last example because I know you're getting tired, is let's talk about reinvestment rates and returns on capital for the entire firm. So this was, going back in time to Cisco's peak in 1999. Remember, I showed you how much they reinvested. Their reinvestment rate, which is all after tax, all reinvestment divided by after tax operating income, was 107%. That's pretty impressive. But what made them even more impressive was the return on capital they earned on that reinvestment was about 34%. Cisco in 1999 was at the peak of the dot-com boom considered the best dot-com company out there, best internet company out there in terms of combined return on capital. It's not a money-losing company. It actually had a 40% or a 36% growth rate. The problem, though, is you look at the following decade, Cisco continued to reinvest 100, 105, 110%. So they kept that part up. You know what happened to the return on capital, though, in the next decade? It went from 36% down to 10%. So now their growth rate dropped to 11%. You're saying, what happened? It wasn't that they were reinvesting less, but they were not reinvesting as productively as they were the previous decade. So when you think about sustainable growth, even if you never use it, it's healthy to start thinking about how much is my company putting back in the business and how well is it investing. And that's why we spend so much time capitalizing R&D and treating leases debt, is we get a much better answer to those questions once we've done that. So as I said, this is the only place in finance, return on equity, return on invested capital, return on capital calculations, where we use book values. So I'm going to end with a slide. And if any of you are interested, you can explore this further. Return on invested capital in particular has now become this metric that every corporate finance consultant and every banker uses as this golden metric. And I have mixed feelings about this. Because if you look at the numerator and the denominator of that number, the numerator is an accounting number, operating income. The denominator is also an accounting number, it's book value. You're saying, so what? Everything accountants do that change those numbers are going to affect your return on invested capital. Now, I have a very long and a very boring paper that you should read only if you have trouble sleeping. I fell asleep multiple times while I was writing the paper. It was so boring, right? It is basically about all the corrections you have to make to get the return on invested capital right for a company based on financial numbers. A couple of those we've already talked about. We capitalize leases. Why? Because we want to get a better sense of how much debt a company actually owes and get a better earnings. We capitalize R&D. Why? Because we want to get a better sense of what the company has invested in its asset and what its true earnings are. But here are a few other things to watch out when you compute accounting returns. When accountants or companies make mistakes, you know what accountants do, right? They write that mistake off. They take a restructuring charge. You're saying, so what? When you take a restructuring charge, what happens to your book value? It's going to drop. Let's say it's 2 years later. You have a company that's taken terrible investments, but it's written off all of its mistakes. 2 years later, when you compute the return on equity or return on invested capital for the company, you're going to get a really good looking number, right? Because you wrote off the $50 billion mistake. So to get a better measure of historical returns on capital, what you have to do, you have to go back and reverse everything accountants do. Talk about nightmares. Take the reverse. Because if you truly want to get a sense, what did my company do over the last 15 years, using today's operating income and today's invested capital is never going to answer the question. But it is worth exploring what your company's return on equity, return on invested capital are before you start telling a story and valuing your company. Because the end game here is you want to create returns on capital that exceed your cost of capital and returns on equity that are higher than your cost of equity. So I'll end with that, and I will see you on Wednesday at 3:30 in the room that you've been assigned to. So don't all come here because it's going to be too crowded.
Market is happening in the changes. It's the only one. Maybe come to that study really. Yeah. The country is trying to bring in zero growth. You take something like this, you say, you know what? Capital is constrained, it's not so easy to come from you to the extent we have a risk free rate in existing time, so it's much higher than what you get to your calculation. So you can look at the real growth rate for that. But you bring that in only when you see capital is not so. I think we have a lot of loss in the and over time, the real growth, the question is what real growth? In the market where capital flows through, the real growth that goes into your risk-free rate is the real growth in the global economy, because everybody's going to convert. That's why we can use the TIPS rate as the real risk-free rate. Okay. All right. Thank you. This is just first 15 minutes, so basically two cash flows, not the rest. Not to calculate from laptops as calculators, or do you use a laptop as a calculator? But laptops you can use only for the calc. You can't use it in Excel, so you can use a laptop as that's where your slides are. You can use it for your slides. You can use a calculator. Hi, how are you? Good. So we have 3 rooms still. You go to one room, Analyst you go to the other. I divide the quizzes up because I think there's 70 people in one room, 50 people in the other. So I love the quizzes person up to 55, up to 75 to 55, like how we do. So you can pick up the 75 cases for the room, and I can pick up the smaller part, the smaller room. I come here, we all start at 3:30, at 4 o'clock, time for everybody, and people from your room, remind them that there's class after the quiz, so they can come back down here. So I give them about 5 minutes to go down here. And if you can come down here after you've done this quiz, and even if it's after everybody else is coming, you can come down to the side. You can and take all the quizzes from here, because I like the one quizzes up there, and take them to my office, take them to an empty room, and start to select them out of that. That'll be very helpful because I start creating easier from the quiz all the alphabetic quadrant grades. So logistically, it's really for the first 30 minutes I need to talk to the quiz. And they open book, open notes, open iPad, they told me they can even open the laptop, the slides, and it takes a digit test. You know, you want to look at one system, somehow you can keep an eye on people. And remind them to write their names in the front of the grade and the back of the grade. That way they're an active grading, you can send them back. But outside of that, the questions, I'll be hearing them here, so if I'm screwed up on the quiz, and those things we have in the grade. You know, we should be getting, but the most part of any questions, we say, look, we make them something we want, because they will ask me things that they really don't need to do. The other way, if they were not don't tell them they need a capture, capture with them from, because otherwise the answering questions that indirectly tell them to do. I would think it's easier for you to pick up the questions from the office and go to the I'll check. I think we're in the fourth row, so. Across this, go down to the fourth row, rather than come down here and then reverse over that. So comment about it. Hi, how are you? You're doing free cash flow firm. It's not supposed to. You decide to free cash flow firm. It's the only number that's if you go free cash flow equity, it'll be netted. So there's no support if you're doing, you're talking about the valuation for your project, or you're talking about, doesn't depend. It depends on the choice you make about how you want to value your company. So it's not driven by a company's cash flow. It's driven by what you decide will be easier for you to do or better for you to do. If you think valuing the business is going to be a safer way to approach things, valuing the firm, then you have to start with operating or revenues and operating margin. If you believe that it's going to be to value equity and you want to free cash